Today is Thursday, 29th of May, 2025, 6 a.m. Eastern Time. This news is brought to you by Preeti Capital, your trusted source for financial insights. The financial markets experienced a day of mixed momentum as investors navigated through a landscape of both optimism and caution. The technology sector emerged as a beacon of strength, driving gains across major indices and reinforcing its pivotal role in the contemporary economic landscape. This sector's robust performance came on the back of strong earnings reports and innovative advancements that continue to capture the market's enthusiasm. Despite the buoyancy within tech, broader market sentiment was tempered by ongoing global uncertainties. Geopolitical tensions, particularly those affecting key trade routes and international alliances, have kept investors on their toes, resulting in fluctuating market behaviors. These uncertainties have not only influenced equity markets, but have also extended their effects to commodities and currency markets. The volatility in these areas underscores the intricate and interconnected nature of global financial systems. Commodities, in particular, have been reacting to geopolitical cues, with energy prices showing sensitivity to any developments that could impact supply chains. Similarly, currency markets have been on edge, with traders responding to shifts in geopolitical dynamics and their potential implications for economic policies and interest rates. As the day unfolded, the mixed signals from different sectors highlighted the complexity of the current economic environment. Investors are closely monitoring these developments, balancing between the potential for growth driven by technological advancements and the risks posed by international uncertainties. This delicate balance is likely to continue shaping market trends in the near term, as stakeholders remain vigilant and responsive to the evolving geopolitical landscape. The interplay between optimism and innovation and caution regarding global affairs presents a challenging yet intriguing scenario for market participants. The major global indices experienced a varied trading session, reflecting a complex interplay of investor sentiment and market dynamics. In the United States, the three primary stock indices experienced declines. The broad-based market indicator dropped by 0.56%, signaling a cautious stance among investors amid broader economic concerns. The tech-heavy index followed a similar trajectory, down by 0.51%, indicating a potential reevaluation of growth stocks that have been under pressure in recent sessions. The blue chip index also fell, registering a 0.58% decline as industrial and consumer goods sectors faced headwinds. The small cap index suffered the most among U.S. indices, with a more pronounced drop of 1.08%. This could reflect investor uncertainty towards domestic-focused companies, perceived as more vulnerable to economic fluctuations and interest rate pressures. Meanwhile, market volatility, as measured by the fear gauge, rose by 1.85%, suggesting heightened caution and hedging activity in the market. Across the Atlantic, the leading UK index decreased by 0.59%, amidst ongoing geopolitical and economic challenges in Europe. The German index also saw a notable decline of 0.78%, indicating concerns over the Eurozone's economic outlook and the potential impact of energy prices and inflationary trends. In Asia, the Japanese market bucked the trend, rising by 1.83%. This positive performance may be attributed to investor optimism about economic recovery and potential policy support from the central bank. The Hong Kong market also posted a gain of 1.06%, driven potentially by anticipation of regulatory easing or improved trade relations. Meanwhile, the Chinese benchmark index advanced by 0.73%, reflecting a degree of resilience amid economic stabilization efforts. Overall, global indices displayed mixed results, with regional economic factors and investor sentiment playing significant roles in the day's trading outcomes. The divergence in performance underscores the complexities facing global markets as they navigate a myriad of challenges, from inflation to geopolitical tensions. In the current financial landscape, bond markets have seen some significant fluctuations, as evidenced by recent movements in yields. The yield on the 10-year Treasury note has experienced a notable decrease, which can be reflective of a variety of factors, including shifts in investor sentiment and broader economic conditions. The decline in yields often indicates increased demand for government securities, suggesting that investors may be seeking safety amidst uncertain market conditions. This trend could be driven by concerns over potential economic slowdowns or geopolitical tensions that prompt a flight to quality. Conversely, the yield on the 13-week Treasury bill has shown a slight increase. This uptick might be indicative of short-term interest rate expectations adjusting upwards, possibly reflecting the market's anticipation of central bank policy maneuvers or inflationary pressures in the near term. Such a movement suggests that while there is a demand for short-term securities, it is accompanied by a cautious outlook on the immediate economic horizon. The yield on the 30-year Treasury bond has also dropped significantly, aligning with the trend seen in the 10-year note. This decline could suggest that long-term growth expectations are being reassessed, possibly due to subdued economic data or projections that influence investor confidence about the economy's future trajectory. These yield movements across various maturities highlight the complex interplay between market forces and investor expectations. As yields adjust, they send signals about the collective outlook on economic growth, inflation, and monetary policy. Bond market participants will continue to monitor these indicators closely as they navigate through the evolving economic landscape and adjust their portfolios accordingly. The contrasting movements across different maturities underscore the nuanced dynamics in the fixed income market, reflecting cautious optimism tempered by underlying concerns about future economic conditions.